Hey guys, and welcome to this video. In this video, we will be looking at Apple. We're gonna see what the stock is doing, how are the fundamentals, is it worth what they are asking for it. I have prepared a 10-item checklist that you can see on the right that will help us give this new kind of content some format, because in previous videos and shorts I have been talking about, discussing and explaining what certain ratios and values mean that you start encountering as you start looking into company financials. So let's have a go at Apple and see how it measures up. What this 10-item checklist will do for you is to help give you an idea of whether you should look more into the company and how, again, just give you a quick idea of what this is all about. And then you can consider it in your research. You should not make a decision based on this. This is just for a bird's eye view of the company. So we'll be using Market Watch for this, from where we will get the data. And so Apple, $3.63 trillion market cap, huge company. And what I recommend you, that I see as a mistake that a lot of beginners make, is to stop looking at the stock price. This is just a very short-term indication of what the company is worth. It's distorted by a lot of things. It's not a good way to value a stock, because a lot of people would see this. They would go, the 3-year, it goes up, it must go up in the future, but that is not the case. This is the past performance, and you want to estimate what the company is going to do in the future, and this does not give you any kind of idea about that. So what I want you to try and do and learn about is to check the market cap, and by watching this video and reading other articles in this topic, you will acquire the tools that you need to come up with your own valuation that you can then compare to the market cap, what the company is selling for, the amount that you would need to pay if you wanted to buy the whole company. So you will have your own valuation that you can compare to it and see if it's selling at a reasonable price. The reason why you can equate the share price and the market cap to each other, they are basically the same thing. If you divide the market cap by the number of shares that are out there, you get the share price. So you either talk in terms of buying the whole company, which I recommend you do, or you do it on a per share basis. The reason why I recommend doing it on a per company level, like imagining that you're buying the whole company, is because that is the thing. When you buy AAPL, Apple, one share, you're not buying a ticker, you're not buying a share, you are essentially becoming an owner of the company. And so you want to understand what it does, how well it's performing, how much you're paying, and what return you're gonna get on your money. So let's get started. So to start off on our checklist, we're gonna go into financials, where you can find all this valuable information. Now, first up is the income statement. The income statement, if you don't know, is a statement that takes, on the very first line, you have revenue, which is just the amount of money that Apple got from selling iPhones, Macs, everything. This is how much customers paid Apple, to make it simple. And then as you work your way down the list, you will encounter different items of expenses connected to that revenue. You will have sum lines, and then all the way down you will have the net income, the net money that they made from those sales. All right, so first off, first item in the checklist, we want to look at the 5-year revenue growth. We want this to be growing. We want this company to sell more as we go into the future. And so we can see that from 274 billion, we are up to 391, which is very good. We can see on the little graph that is a 43% increase, which is massive considering the already huge size of these revenue, and you can see it's a very steady growth. It's plateauing a little bit in the last 3 years, but we're gonna give it a check mark because we do like to see increasing revenues. So next up is, this is what we call top line. Now we're gonna look at the bottom line, which will going to be net income. So after you sell all the iPhones, all the Macs, and you deduct all the costs, how much it costs you to produce those, how much you paid for research, staff, location, whatever, how much is left? That is net income. And we want to also make sure that is growing. So we went from 57 billion up to 93. There was a big jump from 2020 to 2021. The data here is going from left to right. Some platforms may do it the other way, so just know which way you're looking. And so this is relatively flat in the last 4 years. So even though it is a growth, should we be like, if you just look at the 4 last years, that has not grown considerably or at all. So even though it's a check because it grew in the last 5 years, we would be curious what their plan is to grow net income going into the future. So then next up, we're going to look at the 5-year PE. Now that is sort of a basic metric to look at. If we go to overview, it is going to be up there a lot of times. So you will see PE ratio 38. What I like to do is, because this only tells you, this only calculates it based on the last financial year. So what I do is take the last 5 years, again, we are in the income statement because the PE ratio means price to earnings. What is the price? That is the market cap, the price you would have to pay to buy the whole company. What is price to earnings? What is earnings? Earnings is the net income, the amount of money that they earn. So you get a relation of how many times. So like you see, let's take a 5-year average, which I didn't write out, but I will get that from my trusty stock sheet. But we can essentially pretty much guesstimate this. This should somewhere be like 85 billion. And so you have 85 billion. That is on average how much money Apple is earning in net income. If you compare that to their market cap, you're gonna get a number. This number here was 38 based on the last year, but since we take the 5-year average where you had a lower year, now once you're more experienced, or if you are more experienced, you can see why that was and whether you can like forget about that 1 year as that was an outlier. But for us, that lower net income year being there, the average is going to be a bit lower, so the PE ratio is going to be also higher. In our case, it's 41. We would want this to be under 20 for it to be considered not an expensive company, because the general idea is below around 12 you can find undervalued companies. Around 15 it's fairly valued, and over 20 is where things get more on the expensive side. So for this time it's going to be an X on the PE ratio. Now, given if there is growth in the company, which we have seen in revenue growth and net income already, with some caveats, you can pay a higher. There is no set number, so this is up to you. So that's why you should watch a lot of videos from good creators to understand what is happening and how you can make sense of these numbers. By the way, if you have any question or something is not clear as you go through the video, just type a comment about it under the video, and I will be coming back and answering your questions. So then next up is something new that I included in this list, and that is comparing this 41, this 5-year PE ratio to the industry median. Because although it's not directly about the company itself, it is very valuable, and I want you to get into the habit of looking at other companies competing with the company you are looking at, right? So that would mean the industry median PE. So other companies that are also in the same industry, we will take a look at how expensive those are, and then checking where this Apple falls compared to those. For that, I look at TradingView. You can pull up individual companies' profiles, and then you can go in on the top, you see these breadcrumbs, and you can go into the most most specified category, which is telecommunications equipment. Here you have a bunch of stocks and companies listed that compete in this area. You have a column for the PE ratio. Again, that is the current most recent one, but hopefully it's gonna average out. The reason why I use the median instead of the average, the median ranks them up from lowest to highest and chooses the one in the middle, so it's a middle value, while the average, for someone like Sony Ericsson with a 2000 PE, which is insane, that's going to distort a lot, so I just use the median. And so I have my trusty Google Sheet calculate that for us, and that is going to be 31.5 for the industry median PE, which again is our Apple's PE is higher than that, which means Apple is more expensive than the average company in this industry. So that's again another X on the valuation. And the next one, we want to look at the 5-year return on invested capital. So we want to check how much money the company can generate for every dollar that is put into this company. The market average is around 9 to 10%, and I wrote a function that would calculate this, and that gives us 43.08%, which is way above market average. So that is a huge plus. This basically means that if either debt or equity money is put into the company, if someone puts $1 in Apple, they're gonna make 43 cents on the dollar. That is insane and very good. Companies that have a high return on invested capital can use money that they get very efficiently, and can make outsized returns compared to others. They also tend to have like a very big staying power. Like in the case of Apple, it's embedded in people's life and they are everywhere, and it just makes it easier for them to stick around and have this sort of moat that everyone talks about a company should have. And I think Apple definitely does have it, with like people asking, do you have an iPhone? And how I see it, there is Android and iOS, and although there are a lot of others as well, iOS and like sort of the Apple phones are just their own, not category, but they are just seen as the competitor to everyone else, while as they are only just another operating system, call it. So there's like Apple with iOS and all the others. So that is how big of a phenomena it is. So next up, that's 5 down, another 5 to go. We have shares outstanding, which is a big favorite of mine. We wouldn't 5-year shares outstanding. We want this going down, and the reason for that is, if you scroll down, you can find this in the income statement. Basically, you check how much money you got from sales, how much is left over, and then how many shares you have, and how you have to distribute that, and what falls per each share if you were to distribute all that. Now we will see basic shares outstanding, and for good measure I will just take diluted shares outstanding. Usually the difference is not going to be that big. Diluted shares just refers to options that people or companies can convert, or like stock option for employees. So there are some shares out there that can be claimed, not actually in circulation, but can be claimed. So this is the theoretical total number of shares that could be out there. So this is going down from 7.5 billion to 15.4 billion, which is a 12% decrease. So that is a check mark, because we'll like outstanding number of, we'd like to see the outstanding shares go down. And the reason for that is because if there is a company with 10 shares and you own one, you own 10% of the business. Now, if the company buys back shares, essentially removing them from the market, so the outstanding number of shares, 10, is going down. Let's say they buy back 5 shares, so there is now only 5 shares. You still own your 1 share, which means now you own 20% of the business, which means your share is that much more valuable, and you get that much more of the dividends and the profits and shares that they might give you. So we like number of shares going down. The next metric we want to look at is whether the 5-year average of their long-term liabilities, so debt, the rate that has been growing should be smaller than their 5-year revenue growth. Now, 5-year revenue growth, we know from the first check mark, is 42%, roughly 43%. And for the long-term liabilities, we would go to the balance sheet. Now, long-term liabilities is total liabilities minus the current ones, because long-term liabilities are all the liabilities that are due in more than 1 year. So what we're gonna do, it might not always be listed, so you might have to do some calculation, basically total liabilities minus total current liabilities, so you get the total long-term liabilities. In my case, I have my Excel, which we can type in the numbers and total current liabilities, total liabilities, and you would get that the total long-term liabilities went from 153 billion to 131 billion, so it's down minus 14%, which is huge news, because what we want by this metric is to check whether the growth that the company ideally has in sales, whether that is coming from increased debt or somehow better management and better sales. And likely in this case, that is the case, because Apple in 5 years managed to cut their long-term liabilities by 14% while increasing their revenue by 42%, which is very nice. So that's another check mark. Now, item number 8 is going to be, we want to check 5-year free cash flow growth. This is another big one that I'm a big fan of. Free cash flow is basically the cash that you have left over after you're done with everything. The reason why I like to calculate more things based on the free cash flow is because it's harder to manipulate. The way you would get free cash flow is you go to the cash flow statement, and it's basically net operating cash flow plus capital expenditures. Now, capital expenditures is a negative number, so plus minus is a minus. So you would calculate this year by year. So for like 2020, you would have 80 billion plus minus 7.3 billion. So you would have, what's that, 73.3 billion. You do this for all the years, and then you take the average, which will be, as I revealed to you, $97 billion. So $97 billion in cash is what Apple has left over in every year on average. That is a huge number. and we want this number to grow year by year. So after you calculated this column by column, you can see what that free cash flow was in 2020 and in 2024. And you can see on the right, it has grown from 73 billion to 108 billion. So that's a 48% increase in free cash flow. That is I don't know, very nice, surprising, astonishing. I don't know what is the good word, because at the size that Apple is at, growing cash and just revenue 40% in 5 years, that is very respectable. And also, I have found that MarketWatch, if you don't want to calculate this, if you scroll to the very bottom, you will have a free cash flow line. So you can also use that. You can average this out, and that's the average that I am going to use for the rest of the calculations. And for item number 8, that is a check mark because we have the free cash flow growing. Now, for item number 9, we want to look at, if we take this free cash flow, they can use this for 5 different things. They can pay dividends from it. They can buy back shares. They can pay down debt, which we'll be very interested in. They can acquire other companies, or they can reinvest in the business. And this 9th item looks at, if you take this average $97 billion cash flow and you take all the long-term liabilities, basically the debt Apple has, car loans, I don't know, credit card loans, all kinds of loans that they have and needs paying off, how much time do they need with that average cash that they make every year? How much time do they need? So we already calculated long-term liabilities. This is for the last year because that is the most, you don't have to average that out because, sorry, I'm just pulling the wrong window there. So you don't need to average long-term liabilities out because that is the most current state on the balance sheet that the company is going with. So total long-term liabilities is $131 billion, while free cash flow is $97 billion. So that means they can pay down in like 1.5 years. If I reveal to you, it's exactly 1.35 years. So like 1 year, 4 months is all it takes them to pay off all the debt that they want to. That gives them very much flexibility, a lot of easygoing, because if any bank or anyone who gave them debt or a loan has any kind of problems, they can just write a check and be done with it. So that is a very good position to be in. That is another check mark there. And so what you can also do with the free cash flow number that we just calculated, 97 billions per year, is to again look at the market cap and see, not just on a price to earnings ratio, so not just on a price to earnings basis where you equate, where you compare how much money they earn by selling the products in a year to their market value, the market cap, the company valuation of 3.63 trillion. You can also compare that with the amount of cash that they generate each year. And because I said already, free cash flow is harder to manipulate, I tend to trust that a lot more. So we can take the market cap and divide it by the free cash flow, and that would give us how many years you would need to make your money back. Now, I also told you that you are going to be an owner in this company because that's what shares are for. So you get in the company, and this is how many years it would take you for the company to make back your investment in free cash flow, with which you can then pay dividends, pay buy back shares, acquire other companies, reinvest in the business, or pay down debt. So do all good things with it. And if you divide that, calculate that, you're gonna get 37.33, which is a little bit better than compared to the earnings. So that is still an X because it's too expensive. We also want this to be less than 20 because again, that are the companies that generate money and are sort of fairly valued and not expensive below 20. Now, there is always some leeway in this, not leeway, but there is also some movement in both directions, because a company that is growing and you expect in the future the company will generate more money, you should pay a higher multiple for. What's the multiple? No one knows. It's all down to your assumptions. We looked at the free cash flow. We have seen that it grows 48.3% over the 5 years. Can Apple keep that up? That is the big question. It's been growing up. Apple has been in business for a long time, but it's all coming down to your assumptions. If they can grow in this rate, I might be comfortable paying a P ratio of 20-25. Not a P ratio, but a price to free cash flow ratio of like 25. But ideally, you would want to find companies that are below 20, so you immediately know that you are sort of, if you do more research, if you find a company where the price to free cash flow is below 20, you have that much more confidence when looking into more details of the company that they are already at some kind of good valuation that you can then justify and support with other research that you do, because you should not invest based on this. This gives you a good, I wouldn't say a good idea, but like a good what we call it. It gives you a good, idea about, again, what are the areas where you have to look into, what are the areas that you could look into. We have seen that pricing wise, Apple is more expensive than we ideally would want to, or I would want it to be. But again, there is a premium that you can pay for the high return on invested capital that they are earning, because any money that gets put into this business is earning a lot more than for other competitors. And also, it's growing revenue, it's growing net income, it's growing free cash flow, it's buying back shares. These are very, very good things. It doesn't have to worry about paying down debts. So all these are worth a premium over the 20. How much? No one knows. That's for everyone to decide and come up with their own numbers. You could do if you're really into this or you want to learn, you could do a discounted cash flow analysis on this, where you would estimate how much free cash flow the company would have in the coming 9 years, and then on to infinity. There is a method to calculate that, and you would discount it to today's value, and you would get what the company would be worth. And that's a way to put a price on it, but that also factors in some of your assumptions regarding long-term risks that the country that they operate in might have, and what return people are expecting regarding this company. So I think we're gonna close this video off with Apple scoring a 7 out of 10. There is potential to look into this. If I would have to give a price, because I'm willing to pay, let's say 25 price to free cash flow, that would make the market cap 2.43 trillion. So that's essentially 67% of the current one, which means the stock have to fall, a third would have to be cut off from it. So this comes back to, you either talk in terms of market valuation, the company, or per share. Because market cap is 3.6 trillion now, I would want it to be at least below 2.4 trillion so company valuation wise, drop a third, or we can just divide per the number of shares and say that the current share price would have to be below 162 for me to really look more into this. Would I be possibly missing out on Apple going higher up? Absolutely, that could happen. But the idea is there are so many more other companies out there where you are more likely to earn a nice return where they are already at a good valuation point. So let me know in the comments which companies we should look at next, whether you have any questions or anything that I should clarify, and we will go from there. Thanks so much for watching, and I hope to see you in another video. Bye.